Financial markets and institution. Welcome to today's video that we will be proceeding. It is all about financial market. Remember the capital allocation process, financial markets, financial institutions, stock market and return thereby, and the efficacy of the stock markets. How efficient and effective it is, all about it is what we will be trying to cover in these wonderful videos. The capital allocation process, it is a well functioning economy. Capital flows efficiently from those who supply the capital to those who demand it. Suppliers of the capital, individuals and institutions with excess fund. These groups are saving money and looking for a rate of return on their investment. Demanders are or the users of the capital, individuals and institutions who need to raise funds to finance their investment opportunities. These groups are willing to pay a rate of return on the capital that they borrow around here. It is what we are trying to achieve every now and then. So how is capital transferred between savers and borrowers? Probably through the bank. Yes, it can be a direct transfer. It can be through an investment banking houses or the financial intermediaries. Financial intermediaries usually are banks, usually are the investment banking houses, usually any other broker that you want to go around it. So yes, there can be a direct transfer, investment in banking houses and financial intermediaries. What is a market? Till now, we know wherever there's a buyer and a seller, if they are having a common ground, that ground is known as market. A market is a venue where goods and services are exchanged. A financial market is a place where individual and organization wanting to borrow funds are brought together with those who have a surplus of fund, probably, and then they are willing to invest in the business. So types of financial market. We have the physical assets versus the financial asset. We are talking about the money versus the capital. We are talking about the primary versus the secondary. We are talking about the spot versus the futures. We're talking about public versus private. So see the wonderful dynamics of market and types of market: physical assets, financial assets, money, capital, primary, secondary, spot, future, public, private. The importance of financial market. Well functioning financial markets facilitate the role of capital from investors to the users of capital. Market providers saves with the return on their money saved, invested, and which provides them money in the future. Market provider uses users of capital with necessary fund to finance their investment projects. Well functioning market promotes economic growth. Economies with well developed market perform much better than economies with a poorly functioning market per se. So what are derivatives and how can they be used to reduce or increase risk? A derivative security value is derived from the price of another security. Example: options and future can be used to hedge or perhaps even reduce a risk. For example, an importer whose profit falls when the dollar loses the value could purchase currencies future that do well when the dollars actually is weakened. Also, speculators can use derivatives to bet on the direction of the future stock prices, interest rate, exchange rates, commodity prices. In many cases, this transaction produces a high return if you guess it right altogether. So, also speculators can use derivative to bet on the direction of the future stock prices. Definitely, we're talking about interest rate. We can talk about exchange rates, commodities, prices. In many cases, this transaction produces a high return altogether, but a large loss if you guess wrong. Hence, derivative is very risky. Types of financial institutions. We are talking about commercial banks, we are talking about investment banks, we are talking about mutual funds, whatever we are looking into it. We're talking about the credit unions, pension funds, we are talking about life insurance companies, we're talking about hedge funds, and so on and so forth. Physical location, as in the stock exchanges, versus electronic dealer based market, as in the auction market versus dealer market, exchanges versus OTC, over the counter, NYSE, New York Stock Exchange versus NASDAQ. Differences are narrowing. So, what are we looking into it? We are talking about the stock market transaction, as in Apple Computers decides to issue additional stock with an assistant of his investment banker. An investor purchases some of the newly issued shares. Is this a primary market transaction or a secondary market transaction? Since new shares of the stocks have been issued, this is primary market transaction. What if instead an investor buys existing shares of an Apple stock in the open market? Is this a primary or a secondary? Since there are no shares been created, this remains a secondary market transaction. So what is an IPO, initial public offering? An initial public offering is where a company issues stocks to the public market for the first time. Going public enables a company owners to raise capital from a wide variety of outside investors. Once issued, the stock trades in the secondary market. Public companies are subject to additional regulation, additional reporting requirement per se. So historically, the market, stock market performance, I'm talking giving you a S&P 500 and not Dow Jones, remember. So if you look into it, this is the return that goes around. First 1 year, it is 1960, it was 10%. The next year, it was next 2 years, it was quite low, then followed it by little incremental things. And if you see, there is a swing of going in and giving out outstanding rewards. There are chances, and of late, if you have seen the stock market, the chances of giving negative return is quite diminishing, barring 2006, 7, 8, where there was a asset crisis altogether due to the Lehman Brothers. Anyway, that's a different story. Where can you find a stock quote? It can be found anywhere and everywhere in the Wall Street journals. It can be found in Yahoo Finance, CNN Money, MSN Money. You look into it, they are trading out here. This is a screenshot that I've just put it for your convenience. And what is an EMH, as an efficient market hypothesis? Securities are normally in equilibrium and are always fairly priced. Investor usually cannot beat the market except through a good luck or a better information, either of one of them. Levels of the market efficiencies, as in weak form efficiency, semi-strong form efficiency, strong form efficiency, as the case might be. This is what we are looking for it. Weak form efficiency can profit by looking at the past trend. Definitely, yes. A recent decline is no reason to think stock will go up or down in future. Evidence support weak from as in EMH, but technical analysis is still to be used out there. All publicly available information is reflected in the stock prices. So it doesn't pay to overanalyze annual report looking at the undervalue of the stock. Largely true, but superior analysts can still profit by finding and using new information thereby. And what we are looking into out here. So this is what is a semi-strong form of efficiency. Everything is available in the information and it is reflected in the stock price. So it doesn't pay to overanalyze the annual reports looking for an undervalued stock. Largely true, but superior analysts can still make a profit by finding and using new information. Strong from efficiency. Every information, in fact, all information, including the inside one, is embedded in the stock price. Not true, because insiders can gain by trading on the basis of insider information, but that is illegal. So conclusions. Let me come to a conclusions of the market efficiency. Empirical studies suggest the stock market is an highly efficient in the weakest of form, reasonably efficient in the semi-strong form, and not at all efficient in the strong form. Insiders have made abnormal and sometimes illegal profit per se. Behavioral finances incorporates the elements of cognitive psychology to better understand how individual and market responds to a particular situation. Next is what, let me come up with an example. Let's say you hear a news in a medical research company that has received an FDA approval for its one of its product. If the market is semi-strong, efficient, can you expect to take advantages of this information by purchasing the stock? Probably no. Why? Because now if the market is semi-strong, efficient, the information has already been priced in into the company stock price, so it is probably a bit late. Let me give it to another information. A small investor has been reading about a hot initial public offering that is scheduled to go public later this week. She wants to buy as many number of shares as possible she can gets her hands on, and is planning to buying a lot of shares on the first day once the stock begins trading. Do you recommend her to advise this? Probably not, because the long track record of IPOs, hot IPOs, is absolutely not that great. Unless you are able to get it in the ground floor, receive on an allocation of the shares before the stock begins trading. It is usually hard for a small investor to receive share of hot IPOs before the stock begins trading. With this, I come to an end of this video. Thank you for watching it.